With the relaxations proposed in 2015 to the pensions drawdown rules, basically allowing you to draw down all of your fund in cash if you want, came quite a bit of debate over the relevance and attraction of using the funds drawn down for a buy-to-let investment. So to use the money to invest in a property and then to take the rental income as a kind of pension. It's worth just looking at, and this has been debated a little since the suggestions were originally made, the tax implications and the ultimate financial implications of doing that. So initially, you can take 25%, broadly speaking, of your pension fund as a tax-free lump sum. So for someone with 200,000, this would mean 50,000 of the pension fund drawn down will be tax-free. The other 150,000 would be taxable, and it seems that it will be taxable as at the marginal rate of income tax, so as income. Even for a basic rate taxpayer, this could mean that a chunk of that money could be subject even to the highest rate of income tax, currently 45%, and a massive chunk of it subject to tax of 40%. So on, say, this £200,000, for example, fund, you're going to be left with roughly around 140,000. There's going to be then stamp duty, land tax to pay on the purchase of the property, okay, not too much, around 1%, and then the normal expenses that go with buying a property. So even if you're left with around 140, just less than £140,000, that's what you invest. The rental yield that you'll get on that, around fairly good level of 5%, would leave you with an effective net yield on the 200,000 of about 3%, 3.5%, and that's fully subject to tax. Now in the pension fund, of course, if you decided to invest that in a broad range of equities to fit your risk profile, then the income that you receive from that, of course, will also be taxable, but it will be undiminished by the initial tax hit that you will have when you take the money from the fund. So, an equivalent yield from an equity portfolio will leave you with more money in your pocket. Then there's the capital gains tax implications, that if you sell the property that you own, there will be a capital gain on it because it won't be your principal private residence by definition, it being a buy-to-let property. Whereas capital gains made inside the pension fund on buying and selling shares would, of course, be capital gains tax-free. Inheritance tax, the pension fund will be entirely free of inheritance tax, whereas the property that you own will effectively be subject to inheritance tax and very difficult to plan with if you want to retain the income, the rental income from that property. Of course, there would be the standalone income tax rate, the tax recovery charge, on any monies that are paid on death from the pension fund, and that's currently at 55%, so that's not such a good thing around the pension fund. That's after your death, whilst you've commenced drawing down from it, which you would have in this example. But that's going to be coming down. There's consultation going ahead, and that's likely to come down to a marginal rate of income tax. So although there will be a tax hit, it's going to be deferred and after your death, not diminishing the amount available to invest at the beginning. So plenty to consider, but and it's far from a clear choice. Things will emerge as consultation continues over the rest of this year, but a note of caution needs to be sounded on the excitement around buy-to-let with pension fund monies in 2015, we think.